Well, good afternoon, everyone. Let me begin by acknowledging that we meet on the land of the Wurundjeri people of the Kulin Nation and extend my respects to the traditional owners and their leaders, past and present. So let me also extend a very warm welcome to everyone. It is a warm day and it's good to see so many people, both in person and online. My name is Andrew Godwin and I'm Joint Associate Director of the Corporate Law and Financial Regulation Program at the Melbourne Centre for Commercial Law and also an Associate Director of the Asian Law Centre, the two research centres that are hosting today's seminar. So today's seminar presents an opportunity to hear from my friend and colleague, Dr. Michael Taylor, on the topic, is China at risk of a financial crisis? Before I say a few words about the topic, I'd like to welcome Michael to Melbourne Law School and say a few words by way of introduction. As noted in the flyer that you may have seen, Michael has had a varied career in academia and government, including spending time with the Bank of England, the International Monetary Fund, the Hong Kong Monetary Authority, and the Central Bank of Bahrain. He's published widely on financial regulation, and I think you could say, although perhaps not quite as stellar as his namesake Taylor Swift, that he is a global household name, at least in regulatory circles, for producing the seminal article or founding statement for the Twin Peaks model of financial regulation. This is a model that was adopted, pioneered indeed, by Australia following the recommendations of the Wallace Inquiry in the late 1990s, and it's now been adopted by several jurisdictions around the world, including the Netherlands, Belgium, the United Kingdom, and most recently South Africa. And other jurisdictions, including the United States and China as well, have toyed with the idea of moving towards a Twin Peaks model. And it was during the course of my own research on the model that I first came into contact with Michael almost 10 years ago. Until recently, Michael was Managing Director and Chief Credit Officer for the Asia Pacific region at Moody's and spent several years in Hong Kong and in Singapore. Now to the topic. Michael, I think you're in a unique position to speak to today's topic. Concerns about China's economic and financial challenges have become pretty prominent in recent times, particularly as a result of the financial stress experienced in the real estate market and the highly leveraged nature of global China's economic model. I think also that most people would accept that China's post-COVID recovery has been slower than expected and that China has been facing various economic headwinds. Today's topic is therefore an important one, given the significance of China to global economic growth and to its trading partners such as Australia. Of course, history has shown, I think, that China tends to confound those who make bold predictions about its future. The reality, of course, is that China has a huge balance sheet to absorb economic and financial shocks, but at the same time, it does seem to be experiencing significant challenges, such as how to boost domestic consumption and how to reinvigorate private sector investment. Which leads me back to the topic of today's seminar, is China really due for a financial crisis? And if not, why not? So Michael will speak for about 35 minutes. And following that, there'll be time for a Q&A. For those who are online, you can contribute your questions to post them on the Q&A function, and I'll try to take a look at which questions are coming through. If we don't have time to get through all of the questions, my apologies in advance, but please don't hold back from asking questions and sharing your thoughts on what is really a very interesting topic. After the Q&A, I'll then invite my colleague, Professor Rosemary Langford, to close the seminar. So with that, could I hand it over to Michael for his insights on this topic? Michael.
Thank you very much for that introduction, Andrew. I'm not quite sure whether I can live up to that advanced billing. I'm not even sure I'm a household name in my own household. But anyway, and for those of you who took a wrong turning, the MCG is over that way, and you missed the concerts last week. So is China at risk of a financial crisis? Let me start out by giving you my main points. As Andrew's already mentioned, we are looking at a situation in China of slower growth, much slower growth than we've become accustomed to in the past, combined with stress in the property sector, clear signs now of deflationary pressure, and something which I'm going to talk about a little bit more detail later on in the presentation, increased policy uncertainty. And all of these factors taken in combination have raised the question as to whether or not China is at risk of a financial crisis. And the last time that this issue was as actively debated as it is now was almost 10 years ago. Actually, it was in 2015 when we saw a very substantial correction in terms of the equity market in China and quite substantial government policy interventions to try to stabilize the market. And at that point, many analysts working in the financial markets were raising questions about whether China was at risk of a financial crisis. And that speculation, that discussion has reached a similar kind of crescendo in the last 6 months or so. As I will argue, there are key aspects of China's financial system that make a repeat of something like what happened in the Western countries in the 2008 global financial crisis extremely unlikely. I think that there are very distinctive features of China's system, which mean that the kind of risks that we saw crystallize in 2008 in the US, in the UK, essentially in the North Atlantic countries, it's unlikely that those kinds of risks will crystallize in China. But there are pressure points in the system, and two in particular that I would emphasize, which are actually closely interconnected. One pressure point arises from the regional banks, and some of the pressures on the regional banks arise from pressures on regional and local governments, provincial and lower tiers of government, and in particular, the local government financing vehicles, LGFVs, that have been established by lower tiers of government to fund a variety of infrastructure projects. So overall, the most likely outcome is that China will be facing a sustained period of extremely slow growth compared to the situation in the past. I don't anticipate that we will be looking at a systemic financial crisis, but it's certainly going to be a slow growth scenario. And given the way in which debt has built up in the system over the last 15 or so years, that will pose a variety of economic risks, which will be significant even if they fall short of a full-blown financial crisis. Okay, so let me go into a bit more detail. So the background. Pressures on China's financial system are growing for reasons that I think most people in this room will be quite familiar with. First of all, there has been a very clear policy pivot. The Chinese authorities are no longer pursuing a policy of achieving extremely high levels of economic growth, much of which has been driven in the past by high levels of investment, particularly in infrastructure, and much of which has been funded by debt, and particularly borrowing from the large state-owned banks. The objective is for slower but higher quality growth, and that in turn will depend on the development of new industries, especially in the high-tech space. We're seeing, it is still ongoing, a property market correction, and the ripples have spread well beyond the most high-profile developers that have been most affected by the policy, Country Garden and Evergrande, and now we're seeing the implications for the broader economy, starting to work through. And that is still an ongoing process. In my view, it still has a lot longer to run. A third factor, which Andrew mentioned in his intro, is that we've seen a recovery post-COVID and post the elimination of the zero COVID policy, which has been much weaker than many analysts had been expecting. Again, if you look at the forecasts that were being used in financial markets by financial analysts, once the zero COVID policy was lifted, there was a very clear expectation of a sharp rebound in terms of economic activity. The pent-up demand of people not being able to get out and spend would start to appear in terms of much higher levels of consumption. And that consumption boom has to a large extent failed to materialize. I think the latest data that has come out in terms of economic activity over the Lunar New Year period suggests that there has been some pickup. But I think compared to what had been expected at the end of 2022, when the zero COVID policy was lifted, the results have been very disappointing compared to what many people were predicting. And then finally, which is linked in various ways to these various policies, is the pressure on local governments and in particular on local government financing vehicles. And I'll go into that in a bit more detail. So there are pressures here, which are pressures that are affecting China's financial system and which are affecting major financial institutions in China. So if we move to look at some of these issues in a little bit more detail, as far as the policy pivot is concerned, one of the consequences of that has been reduced predictability of policy. Adam Posner, who is head of the Peterson Institute for International Economics in Washington, D.C., has termed this economic long COVID. Essentially, what his argument is that it's not just a matter of the zero COVID policy and the effects that that had, but the overall increase in terms of a less predictable environment, a less predictable policy environment. And if you look at other developments, such as the crackdown on internet platforms, essentially the overnight disappearance of the online tutorial industry, these have led to a much less predictable environment. It makes it much harder for the private sector to make investment decisions. And as a result of that, there has been a general decline in terms of confidence in the private sector and also among consumers. There is a clear pivot towards prioritizing certain industries, especially semiconductors, which are seen as having strategic importance, and electric vehicles, where China senses a market opportunity and where we've seen some Chinese companies such as BYD become market leaders in this particular field. That has in turn elicited a reaction from their main export markets, and we're seeing increased pressure on governments in Europe and the US to effectively find ways of limiting the extent to which Chinese companies are going to dominate these particular markets. But even if this strategy is successful, even if these new high-tech industries are successfully developed in China, and I think, you know, given the policy track record, it would be a mistake to bet against that. But even if they are, then their ability to replace the contribution to economic growth that has been provided in the past by the property sector is extremely limited. They will never replace the property sector as a driver of economic growth. And that means, again, that we are looking at a situation of slower economic growth. So that's policy. And of course, one of the major policy changes has been the insistence that houses are for living in, not for speculation. And that has resulted in again, another shift in policy towards reducing the role of the property sector as a driver of economic growth. The first signs of this were in August 2020 with the so-called 3 red lines policies, which imposed various kinds of restrictions in terms of assets to liabilities, in terms of gearing ratios, in terms of cash to short-term debt on the property developers to try to reduce their leverage. And that was initially successfully implemented in terms of bringing to a halt the very rapid growth in leverage in these major property developers. Another source of leverage related to the property sector has been the household sector. Now, if you look at graphs of household sector leverage, and unfortunately I don't have one to show you, but there are graphs that show household sector leverage over a period of time compared to leverage in other countries. And it's certainly true that household sector leverage in China is substantially below that of many of the Anglo-Saxon economies, Australia, the United Kingdom, the United States. But it has risen very rapidly over a relatively short period of time. And it is now, in terms of household assets to income, it is now above the emerging market average, well above the emerging market average. And it's close to the levels that you see in some of the relatively less levered advanced economies, such as Germany. So the fact that this has happened over a relatively short period of time is, in my view, something of a warning indicator that once you see these kind of rapid increases in leverage, it is a sign that there are stresses that could potentially materialize. Most analysts talk about, and you see these figures used quite frequently, especially also in the media, talk about the contribution to GDP from the property sector of somewhere in the range of 25 to 30%. Those estimates are potentially a bit misleading because they include not just the real estate sector itself, which I think on most reasonable measures is around 8% of GDP. But it includes all the upstream and downstream industries as well. So the cement and steel on the one side and white goods on the other, if you add all that up, that's how you get to the 25 to 30% of GDP. Now, those numbers may indicate a certain degree of exaggeration, but at the same time, it means that the real estate sector is capable of producing what I sometimes refer to as a bullwhip effect. It's very much like Indiana Jones's bullwhip. You know, you tweak the handle of the bullwhip and you get these big effects further down the line. And it's a similar story with the property sector. If it's around 8% of GDP, but it can have some big impacts throughout the rest of the economy. And we're starting again to see that feeding through to the rest of the economy. There had been a managed decline of the contribution of the sector overall, broadly defined, and it had gone from around 25 down to around 21% of GDP just prior to the recent market correction. And that had largely been because the authorities had essentially limited the growth of the property sector while the rest of the economy grew. So that resulted in the property sector declining as a contributor to GDP. But since the ending of the zero COVID policy, we've seen that what had been a fairly orderly managed decline in terms of the contribution of the property sector has turned into much more of a rout. And this is where it becomes significant for the financial sector because its exposure to the real estate market, which is essentially developers plus mortgages, is pretty substantial. KPMG have an estimate from 2023 of around 53 trillion renminbi, just over 7 trillion US dollars. And that is the financial system's exposure to real estate. It's significant. Moving on to the next topic, which is local government financing vehicles. Local governments carried the responsibility for implementing the infrastructure projects that the central government decided would be its major response to the slowdown resulting from the impact of the global financial crisis on its main export markets. And of course, there was an ongoing urbanization drive as well. But many of the provincial governments and lower tier governments lacked the financial resources to actually implement these projects. And so their solution was to set up these so-called local government financing vehicles, effectively local government-owned, state-owned enterprises with a very specific mandate, a very specific remit, often very little in the way of cash flow. If the responsibility is to build a new set of sewers and drains so that a new urban development can take place, there is no cash flow that is generated by that investment, at least in the near term. And so how they funded these vehicles was essentially by borrowing from the banks with a guarantee provided by the owner government, which essentially meant that future revenues and possibly future land sales revenues were being effectively hypothecated to repay the debts that these local government financing vehicles were incurring. The property market correction has fed directly in terms of the ability of LGFVs to continue to service their debt, or the owner local governments to continue to service the debt. The drying up of the property market has led to a drying up of land sales, decline in provincial and regional governments' main sources of revenue. And as a result of that, again, we're starting to see very significant financing pressures arising on the LGFVs. So these factors are ones that have led to the speculation that I talked about at the beginning about could China face its Minsky moment or Lehman moment, depending on how the analyst, the financial market analyst is inclined. But eventually, whether they're talking about a Lehman moment, whether they're talking about a Minsky moment, basically what they're talking about is a situation similar to the one in 2008, where you had a domination of risk aversion, where liquidity, as a result, evaporated from major funding markets. So even major financial institutions, the world's biggest banks, were unable to obtain funding at reasonable cost, or any cost in some cases. And the soundness of institutions which had been considered too big to fail came into question. An episode of this kind becomes systemic, not just because of or not only because of the impact on the financial system, it's when it then starts to have real economic effects as well. And I define a systemic event, not just as an event which impacts the financial system, but which has real economic effects as well. And the transmission channel is through the payment system, and through credit intermediation. And the disruption to the payment system, the disruption to credit intermediation is what leads from a disturbance in the financial system through to real economic effects, to people losing their jobs, to industrial and commercial activity ceasing. And some commentators have drawn parallels with China now. But in my view, they neglect the important differences between China's financial system and those of the West. So what makes China's financial system different? Well, there are four main factors. First of all, the major banks remain predominantly state-owned and state-controlled. In Western countries, major financial institutions became state-controlled after the crisis as a result of interventions by the authorities, but they were not state-controlled and state-owned prior to the crisis itself. That means effectively the government is backing quite explicitly those institutions' liabilities in a way that didn't occur prior to the global financial crisis in the West. Secondly, the state plays a major role in terms of directing credit. Why does that make a difference? Well, the main reason is that when you get a crisis of the kind that occurred in 2008, what tends to happen as risk aversion sets in is that you end up in a collective action problem where no one wants to lend because no one else wants to lend. And for many of the financial institutions in the West, there was a disinclination to lend because all entities face the same incentive, not being willing to lend. As a result of that, the exact outcome that they were concerned about happened because no one was willing to lend. And if the state is involved in actively directing credit, as it is in China, that kind of collective action problem can be overcome. It's not perfect because there are still countervailing incentives, but the state can put a great deal of pressure on major financial institutions to lend and to lend to selected sectors. The third factor is that the capital account remains still very tightly controlled. In fact, following the 2015 stock market correction that I spoke about earlier, those capital controls were significantly tightened and have remained so since that time. Why is that significant? It's because one of the reasons that banking sector distress turns into a wider economic distress in many emerging economies is that the banking sector distress is often accompanied by capital flight. People don't simply pull their deposits out of the banking system, but they pull their deposits out of the banking system and transform them into another currency and move them out of the country altogether. And that, if you look at the pattern, has been typical of emerging market banking crises, whether you look at the Asian financial crisis in 97, 98, or whether you look at Latin America in 1982, it's always the same kind of pattern, that if there's a run on the banks, there's a run on the currency. And if you have the kind of capital controls that China has, that kind of outcome is much less likely to happen. And then the final factor is that the state controls multiple balance sheets. It can essentially use the balance sheets, not just of the large state-owned banks, but also of state-owned enterprises, of the large state-owned asset management companies, of various other kinds of entity which it controls to absorb losses. And those losses could take the form, for example, if you have a troubled state-owned enterprise, rather than that becoming a bad debt for the banking system, there could be organized some kind of takeover by another state-owned enterprise which avoids a default, which impacts the banks. So the volume of risk-absorbing capital which exists in the system is not limited just to the capital of the banking system. It's also the capital or the equity of these other entities that the government controls. So I think there are good reasons for thinking that a full-blown financial meltdown in China is extremely unlikely. These four factors, which I was highlighting as long ago as 2015, when this first round of speculation developed, mean that we are looking at a situation which is less likely to result in the kind of financial crisis that we saw in the West. Liquidity can be recycled. If there is a flow of deposits to the large state-owned banks, they can be lent on to recycle that liquidity to other financial institutions that are in need of support. Similarly, overall financial system liquidity is unlikely to be impacted by capital flight. Even large bad debts can be managed without necessarily resulting in large write-downs for the banking system. And even if they were, then the central government has a number of different options available to it. It could follow the well-established practice in many countries dealing banking crises of recapitalizing the banks. Since it already directly owns them, that would be a much more straightforward process. But it can distribute losses across these different entities that I've talked about. Well, finally, it can practice forbearance. It can simply allow the institutions not to actually write off the bad debts. And the experience of many other countries, well, not many, but the experience of a number of other countries where you have a severely decapitalized banking system and a combination of capital controls is that in those kinds of systems, the system can continue to function quite effectively, at least as far as providing these basic financial services, payment systems, and credit intermediation. So no immediate risk of a financial crisis, but significant risks do exist, even if they don't rise to the level of systemic problems. In my view, a particular area of concern is the condition of the regional banks. Condition of the regional banks. Now, these are usually referred to as city commercial banks and rural commercial banks. Many of them are owned by regional local governments, so not central government owned, but regional local government owned. And although in the terms of China's financial system, these may not be huge institutions relative to the big four state-owned banks, they are nonetheless significant institutions. A number of them feature in the Banker magazine's largest 200 and largest 1,000 banks in the world. They do have significant balance sheets. One estimate is that the combined balance sheet of all of the city commercial banks is somewhere in the region of $6.5 trillion US, which is approximately twice the size of the balance sheet of JP Morgan Chase. So we're talking about institutions which individually may not look that significant, but if you look at them in the aggregate, this is a significant chunk of China's financial system. And why are they at risk? It's because they have significant exposures to their owner local governments, to local government-owned SOEs, property developers, and local government financing vehicles. And this deeply interconnected system remained stable as long as the property market continued to grow, and as long as there was demand for new apartments, and as long as developers could repay the money that they were paying to the local governments in terms of land revenues through the sales of apartments as they were being built. With the correction in the property market, that whole process has started to falter. It's a little bit like riding a bicycle. If you keep a certain steady speed, it remains stable. The moment that you slow down, it becomes very unstable. And for the interconnection between these regional banks, local governments, local government SOEs, property developers, LGFVs, that system has now started to become destabilized. Now, although collectively these institutions are significant, individually they may not be. So again, I think it's difficult to argue that they would rise to the level of a systemic problem. But there could be significant bailout costs for the regional and local government owners. And since they lack the resources to provide a bailout, that means it will fall on the central government. And that's where the crystallization of contingent liabilities starts to become an issue for the central government. Effectively, these liabilities have been off balance sheet as far as the central government is concerned. When you look at the balance sheet of the central government, these potential liabilities are not there. They don't show up on the balance sheet. So when you do the kind of analysis that I and my team used to do at Moody's, you need to look at the risk of the potential crystallization of some of these off-balance sheet items. And there is, in my view, an increased risk that the central government will need to provide some bailout funds to resolve the problems in these regional banks. How big a problem? It's very difficult to estimate. We tried, when I was still at Moody's, to come up with some reasonable estimates, and the data is not really there that allows you to do it. I'll give you one point of comparison, though, which I think is a potential analog to what we may be looking at with the regional banks in China, and that was the savings and loan problems in the US in the mid-1980s. If you're familiar with those problems, I know for many of you those are probably ancient history, but in the mid-1980s, the US deregulated the savings and loan industry, which were essentially entities that provided funding for housing purchase. And when the interest rate environment in the US was deregulated in the early 1980s, the cost of funds of these entities rose quite dramatically. But because many US mortgages are long-term fixed rate mortgages, they weren't generating the interest income that they needed to pay the depositors under this deregulated interest rate environment. And as a result of that, many of these institutions became insolvent. There was also some quite widespread fraud at several of them. And the overall cost, the Government Accounting Office in the US estimates the overall cost at around 160 billion US dollars, which nowadays doesn't sound like so much, but it's in those days, in the mid-1980s, it was about equivalent to 3% of GDP. So if we're looking at a problem which is comparable in China, the cost to the central government in terms of increasing central government debt at a time when the economy is already slowing down could have a negative implication as far as the government balance sheet is concerned. And that's one of the main reasons why you may have seen at the end of November last year, Moody's changed the outlook on China's debt to negative because of the increased risk of the crystallization of some of these contingent liabilities. One sector I haven't really talked about, which only a few years ago was at the top of mind of many financial market analysts and investors that I used to speak to, is the shadow banking system. In China, this covers a very broad range of entities: trust companies, entrusted loans, bankers' acceptances, fintech, money market mutual funds like Alibaba's Yuba, and then a whole variety of other entities. It was a de facto financial sector liberalization. And in 2017, basically, the central government said, okay, we've seen enough of this experiment, we're clamping down on it. And since then, since the central government announced what was called the regulatory windstorm, the sector has shrunk quite rapidly from 87% of GDP, equivalent to 87% of GDP in 2017, down to around 39% last year. So this regulatory de-risking of the sector has been actually very, very successful. A lot of the focus has been on reducing the interconnectedness between shadow banks and the formal banking sector, thereby reducing the risks to the formal banking sector, and that has also been quite effective. Nonetheless, there are pockets of risk that remain. We've seen recently the high-profile default of one of the trust companies. The trust companies in particular are still highly exposed to the property market. So again, it may not be a systemic risk, but there are pockets of risk there. And the trust companies in particular, in my view, do represent a risk, again, of the crystallization of contingent liabilities. Finally, policy effectiveness. I mean, there have been a number of instances that I've mentioned where we've seen policy being very effective. The regulatory windstorm, which cracked down on the shadow banking sector, was a very good example of a very effective policy. But since then, since 2017, policy has become much less predictable, and that has contributed to the risk. In late last year, there was an article in the party's leading theoretical journal, which clearly stated that the financial sector should be subject to the party's policy priorities and to central direction. So there is very clearly a shift back towards a much more hands-on approach and a much more directed approach from the central government in terms of the way in which the financial sector operates. Combined with that is declining monetary policy effectiveness. The PBOC has been through, People's Bank of China has been through a quite difficult period recently in which it's seen some of the autonomy which it has successfully managed to win for itself being gradually eroded. And that is one factor which is probably unrelated to what appears to be a broader issue of declining monetary policy effectiveness. There are signs that China is entering a classic liquidity trap where the central bank cuts the interest rate, and yet it does nothing to stimulate loan demand and to stimulate demand for credit. In the first quarter of last year, corporate credit costs declined by a record amount, and that had absolutely no impact in terms of corporate demand for credit. And the same pattern was repeated throughout 2023. That, in my view, is an indication that China is facing some kind of liquidity trap. And when monetary policy fails to achieve its objectives, combined with slow growth, combined with high levels of debt, it does make more likely the scenario of what's referred to as Japanification, essentially the sort of economic outcomes that Japan started to witness in the 1990s, where you had zero or low growth, but often negative growth, high levels of debt, deflation, and a consequence of that, an economy which stagnated for a very long period of time. That, in my view, is a more likely and bigger risk than the risk of a financial crisis. So just to end with a few conclusions, essentially points that I've made throughout the presentation. No financial crisis in China, but slower growth, I think, is inevitable. Current policy settings make it so. The government's contingent liabilities are going to crystallize to a greater extent than would have been the case if we'd have continued to see high levels of economic growth. That will have implications for the central government's balance sheet. It will have implications for the banking sector as well. An area of potential risk is the interconnectedness between regional banks, LGFVs, property developers, and that may well require some form of central government bailout, which will be costly. We don't know how costly because, again, as I've explained, the data is not there to do a proper analysis of just how big a problem it could be. But I think evidence would suggest that if you get into these kind of problems, they're often quite costly. The financial system itself is going to become less efficient, more politically directed. We're seeing a backtracking on the move towards a more efficient, more market-based system, which had been developing through the 2010s. There's been a definite drawback from that. And that results in a Japan-style scenario of high levels of indebtedness and low or zero growth, looking increasingly likely, in my view. So that's the formal part of the presentation. I've left quite a lot of time for us to discuss these topics in a Q&A. So thanks very much for your attention. I look forward to hearing your questions.
So thanks very much, Michael, for a really interesting and comprehensive overview of some of the challenges. I'm sure there are questions in the room. We haven't yet had any questions online, but please do feel free to send through any questions by utilising the Q&A function. Perhaps I might kick off with one question, Michael, and that is in relation to domestic consumption and the failure to kickstart domestic consumption after the pandemic. I'm interested to know to what extent that's attributable to policy uncertainty, and you talked about that in your presentation, or whether it's just attributable to the fact that traditionally the Chinese have been great savers and they don't traditionally consume as much as one might hope. And connected to that, you mentioned that household leverage has increased beyond what you'd expect in emerging markets, but nonetheless not to any great degree. And so the assumption I expect is that people have plenty of disposable income that they could spend domestically, but we've failed to see domestic consumption coming to the rescue and plugging the gap and taking the place of exports or investment, foreign investment. So why is that? And is that, to what extent is that a real problem going forward?
Yeah, thanks, Andrew. I mean, those are great questions. The answer, I think, falls into two parts. there's a near-term issue and then there's a longer-term issue. And let me deal with the longer-term issue first, because if you go back to, I think it was around 2012, the World Bank worked on a report for the central government where they basically produced a whole series of policy proposals in terms of helping the government to achieve what at that time was the clearly stated intention of rebalancing the economy, moving away from the reliance on investment and infrastructure towards one that relied more on domestic consumption, and where domestic consumption played a bigger role. And the World Bank came up with a whole, it's a very detailed document. It's online if any of you are interested in reading it. And it came up with a whole lot of policy prescriptions for the central government. But core to that World Bank document was the recommendation that the central government needed to develop more of a social safety net. And that meant pensions. It meant more broader universal provision of healthcare. And of course, now with the aging population, I mean, this is going back over 10 years, but I think population aging was already recognized at that time. It also meant, provision for elder care as well. And so the argument was, look, you will get more domestic consumption if you implement policies which are designed to provide people with the confidence that they don't need to build up these large savings. Because yes, China has a very high savings rate, but that is because many people feel that they need to hold very large precautionary balances because they don't know what's going to happen in the future. They don't know what's going to happen when granny gets ill. They don't know what's going to happen if they lose their job. So they tend to hold very large precautionary balances, and that holds back consumption. So if those policies had been implemented at the time, I think we would have seen more of a shift towards consumption. And the interesting thing is that if you go back to 2013, at the third plenum of the 18th Party Congress, the so-called decision, which came out from the third plenum, which was this economic document, which contained 333 policy prescriptions. And many of those were modeled on what came out of that World Bank report. And at the time, again, I mean, I was involved in sort of looking at the implications of this from a credit ratings point of view. At the time, there were a lot of people in the financial markets who were really excited by this because they thought this meant there's a real turning point in terms of how China is going to manage its economy in future. And the decision points towards a world in which a lot of these market-based reforms and social safety net reforms are actually going to be implemented. And again, there was a lot of excitement. I mean, this is just after Xi Jinping had become General Secretary and President. And at that time, it's not easy to remember it now, but at that time, he was seen as a reformer. He was seen as someone who was actually going to carry through these kinds of reforms. And we know subsequently what happened. So I think if you look at it in terms of the sort of longer term issues, it's been the failure to implement a lot of the policies that were set out, first of all, in this World Bank document and then in the 2013 decision. And we haven't seen the sort of move towards reducing the risks to individuals and families, which were intended to underpin consumption. That's the longer term issue. The nearer term problem is related to what's happening, first of all, in the property market and now the equity market. Because one of the flip sides of China having an extremely tightly controlled capital account is that there are very few financial assets that are available for people to invest in as a long-term pool of savings. So you have a combination of a high savings rate and a relative lack of instruments in which people can invest. What's tended to happen is that the property market has become the vehicle through which people have invested. And what we're now seeing with the property market correction is that people are seeing the value of their investments decline. And so again, that's really holding back consumption. And as a result, we haven't fixed the longer term issue, and now there are these shorter term issues in play as well. And as a result of that, consumption really just hasn't picked up. There is a final other shorter term issue, which is the one that Adam Posner has been emphasizing in his articles about the economic long COVID, which is that as the policy environment has become less predictable, that doesn't just affect investment decisions by private sector companies, it also affects individuals and households too. And people don't know what's going to be the government policy next year, the year after. And so again, that makes them, want to hold these kind of precautionary balances because they don't know what's happening next.
Thanks. We've had a couple of questions online, but let me throw it open to everyone who's here in person. Any questions? Yes.
Thank you very much for a very, very fair presentation, because at the moment there's a lot of people who are talking sort of complete doom and gloom, and then there are others who are saying that there's no problem at all, and that was very fair. But I guess my question is, do you think some of the very factors that saves China from having a full-blown financial crisis are also the very factors that are going to make China much less attractive as a proposition for international investors going forward? And I can think of a number of examples. One which you talked about when it came to capital account restrictions. We already have short sellers complaining, or hedge fund managers complaining that they couldn't sell their shares, they couldn't take their money out. They thought that they could. So that's one example. Another one, if we are going to hew all of this closer to law, given that this is law school, is if we think of, say, the insolvency order of Evergrande in Hong Kong, and look, make no bones about it. I mean, those international creditors were smart. They picked some of the most gung-ho liquidators in the market available. But in the recent implementation of mutual enforcement of judgments between China and Hong Kong, one of the areas that was specifically excluded was actually bankruptcy and insolvency. And then add to that the problem that we had a Chubb liquidator in Hong Kong. Was it Chubb or was it someone else? Anyway, going into China to try and recover assets, and then found that he was subject to an exit ban. All of those things, I wonder whether China is laying the seeds in saving the current situation for making it, for future problems in terms of making it welcome for international capital.
That's a really interesting point. I think the answer to that is that China's certainly becoming a less attractive destination for international capital. Whether it's directly as a result of the efforts to save the situation, I would doubt. I mean, I think it's more a product of the fact of this policy pivot that I talked about. And that policy pivot has resulted in this situation, which they're now trying to save. But if you look at the reason why many international investors have turned so sour on China, it's more to do with the policy pivot than it is the efforts to save the situation. It's, I think, a belated recognition that policy under Xi Jinping is not the policy that they thought that China was following, and which had been followed for, under his predecessors, his immediate predecessors. So I think that, the financial markets have taken, or Western investors have taken a very negative view on China now. You talk to many investors in the market, they now refer to China as uninvestable. And that, I think, is partly because their expectations have been completely disabused in terms of what they were expecting from the central government. And it's partly because I think they sense that policy is now turning more inward, that there is less focus on reform and opening up, and much more focused now on pursuing some of these kind of geopolitical strategic goals at the expense of the economy. What you said about the insolvency law issue, I think is also very interesting. I can't remember the author now. There was a book written way back in the noughties. I think it was called China's Long March to the Rule of Law. Do I have?
Randall Peerenboom.
Yes,
Yeah.
that's the one. That's the one. And you know, there was a time when I think many people, many observers of China could sort of say, yes, the way that the legal system is developing is one in which there is greater independence among the judiciary, that the judges are becoming better trained, that their expertise on things like insolvency is developing. And as a result of that, we are seeing a move towards not necessarily a sort of Western style rule of law, but towards a more rules-based system and a more predictable system. And I think, again, one of the reasons why investors, and I'm not talking just about portfolio investors now, but also, you know, Western companies. If you talk to the European Union's Chamber of Commerce in China, I think, again, they have, you know, their members have become very uneasy about the kind of legal environment in which they now have to operate, and they feel again that it's become much less predictable. So I think, you know, this policy pivot, this shift of policy priorities, this move away from reform and opening up towards something which looks much more aggressive in its stance towards the outside world, which is prioritizing strategic interests over economic ones. I think that is really the driving factor here as far as many investors are concerned.
I expect this is a topic on which we should, or for which we should have allocated at least 2 hours. But unfortunately, the time has come when we need to draw this to a close, with apologies for those who provided some great questions online. But let me invite Professor Langford to close the session. Thank you.
Well, thank you. As Andrew said, I'm Rosemary Langford. I'm Director of Melbourne Centre for Commercial Law. So thank you so much, Michael, for those fascinating insights. And in terms of a comparison with Taylor Swift, I don't think you get wine and cheese with your Taylor Swift ticket unless you're paying quite a lot. And I'm sure that Tay-Tay doesn't have to answer such tricky questions. So thank you so much. Really appreciate that. Thank you all for coming. We have a number of other exciting events lined up, so please do sign up for our MCCL monthly newsletter or follow us on LinkedIn. Thanks again, and thank you to Andrew.